Welcome back. Bank of America kicking off its first investor day in 14 years. And it also has provided some new medium-term financial targets this morning. You can see the stock is down almost 3%. Joining us now for an exclusive is the company's CEO, Brian Moynihan, along with our Becky Quick. Becky.
Hey, David, thank you very much. And Brian, thank you for joining us this morning. As David pointed out, this has been a long time in the making. It's been almost 15 years since you've had an annual meeting. Why now?
Well, I think it's time for us to put the Bible on the table, how all the business are performing. So our teammates are in there telling our investors, we've grown, we have the potential to grow even faster, we have competitive capabilities that very few have, and that growth turns into great returns, and those are the targets that were referred to. And we just have, it's a chance to do it all at once. And so we meet with investors all the time, directly with them one-to-one through the sell-side analysts and everything. But we said, you know what, we need to lay it all on at once, a lot of data, 300-plus pages of data, where people can see the tremendous value we create, $8.5 billion in earnings last quarter, and how we create it in each of the business lines and what's core to how we grow.
Hey, we can talk through a lot of those specific targets in just a moment, but just looking at the stock today, it is off by 2.8%. Year to date, performance is okay. It's up by 18%, which is a strong performance. Over the 1 year, I think up by about 25%. But Brian, if you look at Bank of America versus the other 5 major Wall Street banks, Bank of America is at the bottom of the pack in terms of performance for the 1 year, for this year, for the last year, for the year before, and even for the 5-year. What do you think the street is hearing today that it is not helping with the stock this morning, and how do you convince them that you've got the plan over the next several years?
Well, the plan convinces them, and the teammates that are delivering it will show it. So if you think about it, we've outperformed the bank index. We have a heavy NII P&L. So we have a great investment bank, a great markets business, and that NII is growing faster. Our growth in NII for this year, 25, will be 5 to 7%. And what we will tell people is that continues for many years, and that's against an industry growth rate of 2 to 3% at best. So it's driven part by good loans and deposit growth, and it's driven part by the repricing of the balance sheet as it grows through. So that's what produced the 31% EPS growth year over year. And, you know, we gave them targets, a return on tangible common equity of 16 to 18%. We just achieved 15. And we'll achieve the bottom part of that range over the next 8 quarters or so, and then move into the medium to high point of that range over the next 3 years. So it's a good, solid target. It's based on an economy that continues to grow. But those returns across this franchise driving this core organic growth are tremendous. And we're also showing people how we've applied technology to continue to manage our headcount carefully and drive the capabilities of companies invest, which few can do.
You raised your guidance for return on tangible common equity to 16 to 18%. Previously, it had been towards the mid-teens. You raised your guidance just in terms of operating leverage, 200 to 300 basis points. Previously, you've been guiding towards the lower end of that. But the stock's still down 3% almost. Why do you think the stock's down today?
Look, we are a long-term player, and so what happens on a given morning, it has a lot to, we ran up in advance of this, but, you know, look, if you're investing in our company, you should be investing for the long term, and that's what we've done. We continue to generate strong returns, strong capabilities, and continue to grow the core franchise, and I think that's one of the reasons why we did this today, is people are getting caught up in the issues of the moment, forgetting that in the end of the day, if you think about Jim DeMar and the markets team, 14 straight quarters of year-over-year trading, sales and trading revenue growth. Nobody's done that in the business. If you think about Matthew Coder over the last 4 or 5 years, moving from 4th to 3rd investment banking, you think about our consumer business growing a core consumer deposit base to $950 billion. And these things were down to long-term value. So long-term investors, you know, here we come.
Yeah. Hey, Brian, one of the issues that the bank's been facing over the last several years was the big hold-to-maturity portfolio that you all had. Treasuries, some long-term mortgages that were locked in at much lower interest rates. You did talk about that this morning in terms of the fixed-rate asset repricing benefit that you expect to see between 2026 and 2031. You're saying it's $450 billion to $490 billion that will flow to the bottom line over that period of time. What are you going to do with that cash? And what do you see as being the place to put it now?
So if you think about our business, we have loans, we get deposits in from our customers and we make loans. The difference with our business and everybody else is we have an extra $1 trillion of cash every day. And so back, we had to invest it to extract the value of those deposits. And we did it for the long term. And what you're seeing, that's the point I made earlier about we have 5 to 7% NII growth this year, and it will continue to next year. And other people are flattish to up a couple percent. And that's 2 to 3 percentage points for that repricing, but 3 to 4 percentage points the good old-fashioned way, growing those loans and deposits. What we do with this, we invest it all along the curve. So while we have a held-to-maturity portfolio, we have much more than that, invested $700 to $800 billion invested in cash and overnight securities. So it's a huge amount. Team does a great job, but you have to think about that, extracting the value of that deposit franchise, because the advantage is on the deposit side that we have, and that's what we do.
You've been known as somebody who is a bit risk averse, and that was seen as a really good thing when you came in 2010 to manage Bank of America, because there were so many problems after the financial crisis. It needed somebody who was going to look at things in a very different perspective. Some people call it risk averse, other people call it risk management. From your perspective, is it more than just semantics on this? What's the difference between being risk averse and being a really good risk manager?
I'll let you all parse those words. At the end of the day, we've grown. Look, what's the issue of the moment you hear about today? Commercial credit quality. Ours got better in the third quarter. Consumer credit quality. Ours got better. We have not had a deep recession, other than the pandemic with all the stimulus that covered up, since 2008, frankly. And so think about how long we've gone without a consumer side, major change in unemployment, et cetera, and you're still running 4.3%. So we run our portfolio so to perform over many periods of time, and that allows us to have less capital and stress tests and things like that. On the other hand, Jimmy DeMar puts $1 trillion balance sheet in the market every day, and that's helped grow those revenues. So we take a lot of risk in the company, but we try to take it the wrong way so that the growth we have sticks to the ribs. And we know, things, certain aspects that you hear about just in the market over the last few months, we know those come and go, but the key is just to keep driving the business. So private capital, private lending, all this stuff you hear about, we have an answer for that for our clients. We have made a commitment to a pool of capital that will support them when they need it, and that'll be $20 billion. Sounds like a lot, but in the case of $1 trillion balance sheet, not a lot. So we're driving the competitive responses, credit card growth. We've grown the core book nicely, and we plan to grow it in the future. So as you think about the company, it's that stick to the ribs growth we're after. We're not after run it up and run it down. Frankly, we saw that before the great financial crisis, and we understand what it's like to take the biggest consumer brand in America and have to deal with the aftermath of a consumer side unemployment levels.
David Faber has a question as well. David?
Yeah, thanks, Becky. Brian, given the long-term nature of the forecast you're sharing today, I'm just curious about how you think about your own future. Becky mentioned it. You've been CEO for 15 years. It's a long tenure in any industry, certainly. How many more years do you see yourself doing this? And what, if anything, do you have to share in terms of succession?
Well, we have our board runs a process with us, and we deliver both inside or outside views of that every quarter, every 6 months. We continue to do it. We're always looking at that. The idea that, and Lionel's and the board members made clear, this management team you see is a ton of talent, and that's one of the other purposes today is to showcase not only Jim and Dean, who are co-presidents, and Alistair's the chief financial officer, but all the teammates that drive this company. So our 8 lines of business, our big platforms, we have 50,000 people work for us in technology, and Harvey's going to talk about that. We have 40,000 people work for in operations, and Tom Scribble will talk about that. So the idea is to showcase the talent that's deep in this company, and we have a great choice of successors and possible leaders in the future, and we work on it all the time and make sure they have the experiences they can do that.
Sarah Eisen has a question, too.
Yeah, thanks, Becky. No, Brian, you alluded to the environment, the good consumer credit quality that you're seeing, and you've been pretty consistent that things are looking good over the last few years with the consumer, with deposits, with balance sheets. Do you see any change to that? Is the outlook still strong?
Yeah, so if you look in our customer base, which is a good sample size, it's 60 million plus customers. It's 40 million core consumer checking accounts where you see their deposits come in from their employer and also what they spend their money on. And we talk about this often. So in the third quarter of 25, that grew 5% over the third quarter of 24. In October, we just got the information, it grew 6%. So it's actually speeding up. And within that, you saw some of the dialogue. I listened to what you were talking about before. Look, there are certain places places where consumers aren't spending as much money and being careful, lower income cohorts and things like that. But on the other hand, they're all growing. Even the lower income cohorts are spending more money this October than they did last October. It's the medium and higher income cohorts that are spending more, and that's bringing the average up. And so as you look in that, people are booking vacations. You can see cruises are still strong. People are going out to dinner. You can see restaurants are still strong. You had some dialogue about different types of restaurants will fare differently, but that's good. And then if you go to the small business side, we're the largest small business lender in America, not the largest one across all of America. And that's what's interesting. If you look in what we see in our consumers and our small businesses, and you mentioned this, are a little bit sort of trying to figure this all out. And we've added an equation which is labor supply to them so they can bid on contracts and they can be confident in what they're doing. That I think we hear from those small businesses more now than we heard last year, which was all about inflation, for example. So that consumer's in good shape. Their credit quality is in good shape. There are parts of it that are a little bit different in the sense that the lower moderate income households and some of the subprime that you're reading about, but that's not at Bank of America. But we have those consumer checking accounts, and they continue to spend, and that's good news for the economy.
Hey, Brian, we are now in the longest government shutdown ever. Today officially makes this the longest. Do you worry about that? Do you see it in the economy? And how long before this does some actual damage? How do you measure this in terms of fourth quarter GDP?
Well, I think about it three ways. First, just because those are our teammates service those clients, those government clients. We have several 100,000 of them. We provide them benefits to help them through those tough times like we always do. So that's number one, what we think about. How do we take care of that? And some of those government employees are our teammates' families. And so we try to make sure everybody's taken care of. If you go to the more broad effects of it, right now you don't see a lot of effect of it, but there's assumption this always ends. And I think that assumption, if it's not met, could have a different effect than people think. And the longer it goes on, it's not necessarily the activities that we talk about a lot in the higher levels and economics and stuff like that. At the end of the day, if I need certain activities, I need certain permits, I need certain things, I need the federal government to act. If the people are not at work, you'll see the impact. So you're hearing a lot about FAA staffing and flights, and even our people coming into this conference, they got delayed, and there's enough air traffic controllers, are they working, and things like that. That will affect the economy over time. So I think it's in the best interest of everybody, and frankly, everybody from both parties says this, to get this solved. It just got to get solved. And I think then we have a fairly constructive view of the fourth quarter and the first quarter next year and all of next year sort of growing at the 2% level. But I think it could affect it. Right now not, but as it goes on, it could. And that's more about the activity gets constrained by these activities as much as the activities about the impact on sort of federal debt levels and things like that, which are further out.
Okay, Brian Moynihan. Brian, thank you for joining us today. We really appreciate it.
Thank you, Becky.
Thank you. Sarah, we'll send it back over to you.
Thank you, Becky. I'm Brian Moynihan on the Investor Day. Still to come, major moves for